in insurance, we do focus a little on risk management, and there's three strategies that are kind of the go-to. One is avoid the risk, two is minimize the risk, and three is transfer the risk, which is essentially an insurance policy. That's your risk transfer method there. I'm asking all of my guests now if they could share with us their biggest risk, and then if you could describe how you go about managing your biggest risk.
I'd love to, but really quick, you reminded me of something my dad always says, and you'll love this. You know, my father, who's a great attorney, mostly an advocate for the have-nots in the world as a personal injury attorney, but he's one of the good guys. You won't find him on a bus stop or on a billboard. He would always say, you can't have too much insurance in business because the incremental cost for adding more insurance is so cheap versus the risk that you're transferring, right?
Right.
So, at BAM, we've got a ton of insurance in every possible manner that you could imagine, because again, it's transference of risk and, umbrella policies for my family, so on and so forth. Going outside of the insurance spectrum here, risk is a huge part of owning a lot of income property, especially at this point in the cycle. And so we're constantly looking for ways to minimize risk. One of my biggest risks, or perhaps the biggest risk, next to just executing the deal, which is why we have a management company in-house. We're either going to win or lose on our own account. I would say the next biggest risk, and in some ways even larger, is debt maturity risk. Because that's what really hurt a lot of people in the great crash, is that you had capital markets that were locked up, right? And you couldn't roll over the debt, or your debt was called by the bank, and you had to turn over an asset that you were paying the debt on. You're making payments every month, and banker comes along and says, "Hey, we did a new valuation, and we'd like you to write us a check for $1 million or put the property up for sale." So we don't want to be in that position. So we avoid the banks. We primarily use Fannie and Freddie agency loans, and we also use HUD. We've got several HUD deals. Most people ask me if that means I manage a lot of subsidized housing. It's a common myth. Almost everybody thinks that, but HUD actually finances A, B, C, and D assets all over the country. And what HUD allows me to do is virtually eliminate downside risk and maturity risk, in that I can lock in my interest rate 35 years on a 35-year amortization schedule. And I can still, depending on the program and the points I pay and the interest rate I take, I can still have a prepayment penalty burn off after 5 or 10 years. But if everything goes to in a handbasket, I don't have to do anything with my HUD debt. I can continue to cash flow, batten down the ship, and ride out the storm. And that, I think, will suit us here at BAM very well over the next 10, 20 years.
No, I appreciate you sharing it. On the HUD, I just want to, is that affordable housing? Is that what we're talking about? Or is that?
It's not.
No?
I'm using HUD on market rate housing. That I think what you're asking is it tax credit housing? Is it affordable? And so affordable gets thrown around a lot, right?
Well, yeah, and I meant tax credit. I guess what I was looking at the
right. So these are not tax credit. These are not bond deals. We buy market rate housing, and we simply, instead of going to a bank or Fannie or Freddie, we go to HUD and we get a little bit higher leverage, a lot more brain damage in getting the HUD money.
Record keeping, right?
In compliance.
Yeah.
But for that, I get 85% loan to cost. So acquisition, renovation dollars, reserves, big reserves, 85% loan to cost. 35-year amortization, 35 years fixed if I want to keep it that long, even though I'm doing a 7 to 10 year hold in most cases, or a 7 to 10 year refi. If the proverbial shit hits the fan, I can just sit there and cash flow with HUD.
And is the HUD product, is it available all through multifamily I mean, is there a
A, B,
unit?
C, D, and E asset, or D,
I mean,
A, B, C, D, F assets you can finance with HUD.
really?
Oh yeah,
That's interesting. I always hear
yeah.
the Fannie and the
Older,
Freddie
the
references.
older and smaller it gets is harder. Well, so I'm very lucky. I've got one of the biggest HUD shops in the U.S. Based here in Indianapolis, and I'm really good friends with that shop. They've been doing it 25 years. They've got a big bank on the other side of the org chart. So they bridge me to HUD. They underwrite me to HUD up front, just like your mortgage broker on your house would underwrite you to Fannie up front, and then they hold the loan until we close the HUD funds. And it's a great program. It works really well, and it takes a huge amount of risk right off the table, which as a young, dumb developer learned the hard way is a very good thing.
Yeah, downside. Yeah, minimize
Yeah.
the downside. No, that's
Hey,
awesome, man. I
Warren
really,
Buffett said it first, right? Don't lose money. That's the
yeah,
first rule. Second rule, remember rule number one. Then let's
yeah.
figure out how to get some yield.
Yeah. No, I love that. I really appreciate you sharing that. That's been one of
Absolutely.
the. I love asking that question and seeing what I'm getting back, and the answers have been just very fruitful. So appreciate that.